All right, we are live. I do believe we are live. We are live. All right, all right, all right. There I am. Oh, no, you know what I forgot to do? Oh, let me just get, I forgot to present slides from the my computer. Desktop. Where are you? Oh, where are you? Hold on, everybody. I know you're all there. Hold on. What the heck did I do with this? Hold on. Please hold. I'll treat as technical difficulties. There. Oh, just pulling up the slide here. And let me see. Okay, save a copy. I put it right here. I put it in there. Okay, hold on. I don't think I did that right. Hold on. Save as, browse, desktop. Oh, it's already there. Okay, good. Okay, hold on. Here we go. Here we go. Desktop. There we are. Beautiful. All right, I got it. Hey, while we're waiting for that to process, I just gotta break some news here, some breaking news here. Allow me to be the first one. Allow me to be the first one to inform all of you. Jerry Springer will not be down for breakfast, as we say here in Boston. Jerry Springer is passed away at the age of 79. We all know him mostly for the Jerry Springer Show, or some of us might remember him as the mayor of Cincinnati, who was drummed out of office because he tried to pay a prostitute with a check. I can't make this stuff up, folks. I just can't make it up. But that was Jerry Springer. That's what he's known for. Don't let it be you. Don't let it be you. Hello, Francis. How are y'all? Okay, here we go. I'm going to start my presentation. Now, let me explain something to you. I talked about this with my Monday night clients. And the Monday night clients, I really wanted to talk about this concept of how do you build your multifamily business. And there's, the way I've been teaching it for years, and there's this new concept. The new concept I call the passive investing model for multifamily millions. Okay. And then I call mine more like the Warren Buffett model. And what I want to do is kind of show you what I mean by those two different concepts of building your multifamily business. So let me come on over here, and I'm going to do it this way. Add to stream. Here we go. All right, so we got the passive investing to millions, or the Buffett model. And if those of you who are on the call right now who've already seen this presentation, I fixed it. I corrected Warren Buffett from Warren Buffet. Let's see if I made all the corrections, because I spelt his name the wrong way. throughout the whole entire presentation. So let's take a look at it. So first off, let me explain to you what the passive investing model is as I see it. And this comes from Forbes. I'm trying to grab as many references, third-party articles as I can. I give attribution to it with just an asterisk and a thing. I don't cite the actual article or the date or what have you. I understand I'm not giving it proper attribution, but this came from a Forbes article. All it takes to be a passive investor is to choose a sponsor group, select the property they are, selecting the property that they are buying, look at all the legal documents, sign your name, and send your money. And that's it. You're a passive investor. And now you can go about telling the world that you own X number of units. Okay, yeah. Who's Zoom user who might be Evan, usually is Evan, says he's got Warren Buffett's autograph. I want to see that next time you're in your office. Bring that to me. Next time you're in my office, bring that to me. So that's all it is to passive investing. And I comment about that, and when I started seeing this trend of all these passive investors, all these multifamily investors who own thousands of apartment units. And I started getting them all on my podcast. They all call them up. They want to tell the world that they're, a passive investor, or they can get you started in the multifamily business. And there's some gurus that this is their model. This is how they teach multifamily investing. And I think to myself, some of these people claim they have 4,000 units. And this is somebody that I personally know. This person goes out there and says, I own 4,000 apartment units. They've never once set foot in any of those apartments. They have never once walked a property for due diligence. Oh no, I have Jerry. Oh, you have Jerry Springer's autograph. You know what? If those of you knew Zoom user like I know Zoom user, that makes much more sense. That he has Jerry Springer's autograph and not Warren Buffett's. That sounds so much more in line with that character. So, these guys with multifamily 4,000 units, they've never walked a property. And that's how they're going to build their multifamily business by investing. I'll put 50,000 in this guy's deal. I'll put 50,000 in that guy's deal. And now I am a massive multifamily real estate tycoon. Does that really get you to where you want to be in multifamily ownership? And I always think back to when people come to see me speak, I always ask the question, where do you see yourself in 5 years? I want to own 1,000 apartment units. Okay, but do you want to do it by just putting 50,000 of your IRA money in one guy's deal and 25 in another guy's deal? Is that your idea of being this multifamily owner operator? I can't imagine that it is. But they get rigged into this passive investing concept. So what are the risks to passive investing? Really, the risks to passive investing are the same as the risks to what I'm going to tell you, the Warren Buffett model. Your funds are illiquid. You can't get at them until the deal is done. You really have to sponsor vet the sponsor group, because it's like when I did that conference with all the bankers, they said, we just look at the sponsor. We want to see the sponsor. We want to know what the sponsor is all about. And there's always a risk that the business plan will not be executed according to the pro forma by the sponsorship group. Boy, did we see that happen down in Houston when that guy lost all 4 properties. I bet that all those investors, all those passive investors were wondering, wait a minute, how'd you just lose all 4 properties? Because we were counting on you to do exactly what you said you were going to do. I think if I remember correctly, there was a clue in one of those newspaper articles. Maybe not, you had to dig down a little deeper. I think I dug down and I saw that on one of the properties they purchased for $42 million and they got a $47 million loan. So there's $5 million of cash that is being expected to be invested into that property. Nothing was ever done. So that's one of the biggest problems that with these sponsorship groups is you just hope these guys know what they're doing. Now, what's the Buffett model? What's what I call a Warren Buffett model? This is all my invention and my creation. It's not like you can go Google what's the Buffett model for multifamily. It doesn't exist. I just made it all up. Okay, so let's understand who Warren Buffett is and how he got his start. You've all heard about Berkshire Hathaway. Berkshire Hathaway was started back in the 1800s, and by the time Warren Buffett came along, it was a merger of Berkshire Cotton Manufacturing and Hathaway Manufacturing Company, all in Massachusetts. The company was taken over by Warren Buffett's investment group in 1965 and quickly rose to prominence through Buffett's strategy of value investing by buying up stock or companies that were undervalued. Buffett transformed an initially struggling textile manufacturing company, that's what Berkshire Hathaway was, into what is now one of the biggest and most expensive conglomerates and stocks in the world. Folks, isn't that more of a vision of what you want to do in the multifamily business? Instead of putting a little bit here and a little bit there, don't you see yourself more as the person that goes in there and buys a property undervalued? You understand what value is, and you know how you're going to unlock it, and that's how you're going to grow onto your next business, and you just keep accumulating businesses, multifamily properties, until you've got this conglomerate of 1,000 apartment units. Isn't that more of the vision that you were expecting when you sat in my banquet hall and I asked you, where do you see yourself in 5 years? Or do you see yourself having some other guy out there doing it for you? Neither answer is right. Neither answer is wrong. It's just, what was your vision? If you think that the Buffett model is where you want to be, then don't get sucked into those guys who are selling you a bill of goods with the passive investing. Now, here's a real issue, and this is something that really sets the passive investing world apart from the Buffett model world. Berkshire Hathaway has paid a dividend once since 1965, and it was pennies on the dollar, but it was a good dividend. But the point is, and even Warren Buffett says, I must have been in the bathroom when that got voted through, because he doesn't believe in making a distribution, making a dividend. Okay, despite holding $106 billion in cash and actively pursuing investment opportunities that do offer dividends, Buffett's company refuses to issue dividend payments to shareholders. All right, he believes that investors benefit more from the long-term growth of their stock values than from a yearly cash payment. Think about that for a second. Think about that when you listen to these people talk about their deals and what the preferred return is of their deals. I tell you, when I first got started in this business, preferred returns were something that you would offer when the property was a top shelf property and you were looking to get solid money in there, accredited investors. Now, if you don't have a preferred return, everyone's like, whoa, well, why would I want to do that? You're not even giving me a preferred return. Folks, if you need that income from a preferred return, then your vision of multifamily real estate investing is entirely different than mine. You see, I think more like Warren Buffett. I think I understand the power of the cap rate. And I know that there is no better return than increasing the net operating income by $1 every chance you possibly can. And if it means me holding on to the dividends, the distributions, and driving them back into the property to make the property better, I know I'm going to make you more money long term than I ever would with a cash on cash return. People don't buy Berkshire Hathaway and say, what's the cash on cash return? It's zero. It's zero. Well, then I'm going to go put my money with, the guy down in Houston who owns 4 apartment units, and he's going to give me a 9% preferred return. No. If you understand that on a 4 cap property, if you raise the net operating income by $1, you've increased your value, your net worth by $25. So why would I want to take any money out of that Midas maker and give it back to the cash investors who then have to pay taxes on it? And why wouldn't I want to keep it in this conglomerate and buy more and just keep buying more? That's the model that Warren Buffett follows. And why don't we see more of the multifamily investors teaching people this method? This is the right way to build that beautiful business that will launch you into the next generation and the next generation, not by living off 9% preferred returns that accumulate because, well, we didn't hit our 9% preferred. You should drive that money back into the property. All right. Buffett believes that profits are better spent on reinvesting in the company, especially when the company is intent on growth. 20 in the first year, 5 years, 1,000 apartment units. Sounds pretty good to me. That sounds like great growth to me. Now, let's take a look at some numbers here, and this is where things are going to start to get interesting. Warren Buffett doesn't pay a preferred return. That doesn't mean you shouldn't buy his company's shares. As usual, it all comes down to personal preference, like I said, and what you're looking for in an investment opportunity. While some people will rue the lack of a preferred return, boy, I hear that all the time, they're unlikely to complain about the value of their returns. Berkshire Hathaway has grown by 3.6 million% between 1964 and 2021, while the stock Standard & Poor's index has grown by 30,000% in the same time period. Which one would you rather be? So let's break down the numbers, because this is very interesting. This is like, okay, Charlie, yeah, I understand what you're saying, but let's think about the numbers first and let the numbers do the talking. Let's assume that you're buying a multifamily property for $5 million acquisition price. Loan to value from the debt that you received is 80%. That means you've got to raise 20% in the down payment. You're going to build in a 3% acquisition fee to the GPs, to you, or to whoever it is that is running the GPs. You might be passive in this. And then we're going to add another 2% closing cost just to keep it even here. That means you've got to raise 25% of the $5 million acquisition price in order to close the deal, or $1.25 million. Now, in order to raise that $1.25 million, you've got to go out and sell off membership interests in your company, in your Berkshire Hathaway. And so you decide that the way that you're going to do it is you're going to sell off 70% of the company and you're going to keep 30 for yourself. So that 70% of your company is now valued at $1.25 million. In order to get those people into your deal, you think, I'm going to give them a 9% preferred return because that sounds good. All right. Now, the passive investors, that's you. Remember, these gurus are out there teaching you. You find the deal, you put it together, you go raise money among limited partners. And some of those limited partners want to be a GP. So you make them do the heavy lift of finding the money and you give them a slice of the pie, right? You don't know how many people show up on my podcast and that's what they do. They go out and they raise money for other people so that they can get a piece of the action. At the end of the day, and that's how they get into multifamily investing. So in this particular situation, a typical split for these money raisers. If they raise $1 million, they're going to get 20% of the GP share, so 6% of the total deal. And so 20%, whatever the GP gets to keep, they get 20% of whatever the GP raises. Okay, raises as far as like the acquisition fees, what I'm talking about. So that's a typical deal. You guys think it sounds great, right? Oh, this is fantastic. I'll go out to all my friends and family and I'll raise $1 million and I'll give it to them. And I get 20% of the acquisition fee. So 20, that's $30,000. And I get 6% of the deal. Wow. And it's not even my money. I just got grandma to give me $1 million. And that's how people get into this business. Now, what did you actually do? What did you become when you got into the business that way? Let me show you. Let's further assume that the property is going to, in its lifetime, it's going to generate a net profit of 10%. That's all it could generate. 10% is not a bad return. It gets 10% return every single year. Yeah, exactly, Good Samaritan. But it goes even deeper than that, Good Samaritan. Essentially, you think about it. Think about those guys who get into multi-level marketing. All they're doing is find their friends and family to come in there and buy the soap, as my mother used to say, buy the soap. And then they move up the food chain while everybody below them tries to get rich themselves. So 9% goes to the LPs and 1% goes to the GP. So remember, this guy now owns 6% of the GP share, not of the preferred return. They get the GP share. So now they're taking 30% or 20% of 1%. So if the GPs take home $12,500, the passive investor gets $2,500. So their total take for raising $1 million is $2,500 plus $2,500. Their share of the acquisition fee, their share of the distribution, $5,000 in the first year, $2,500 per year until final disposition. Is that millions? Are you getting to your multifamily millions on this model? Break it down and understand that you're just working for someone else. That's essentially all you're doing. And Good Samaritan, great example. You're a securities broker. And what do we say about securities brokers? They're broker than you and me. And now we see why. They're basing their entire business, this entire new passive investing business, on transactions. They're a transactional broker. They make their money when the transaction happens. And really, just think about it. That's like building a block of business as a securities broker. You get a little bit of cut of every one's money that you build up. But at the end of the day, when those people sell all those securities and they move it somewhere else, you've got nothing. And in this particular example, when the GP sells the property in 5 to 7 years, you've got nothing. And I'll tell you, the people that I speak to, the ones who are making millions in this business, are the ones that understand that it's not a 5 to 7 year hold. You buy these properties, and the way that you earn money and build up that huge net worth is you hold them over time. I just did a podcast with Joel Friedlander. I'm gonna forget his name. I can't remember his last name. Great guy. He's an investor, industrial units out of Chicago. We had this exact same conversation, and he shared such great light on exactly what I'm talking about here. And I want everybody to start thinking differently about this whole concept of passive investing. Let me keep going on here. All right. Now let's assume we use the Buffett model to grow. In that same scenario, but this time we're going to start smaller, and it's going to be us and maybe one partner. And we decide we're going to buy 10 units. 10 units. Oh, wow. Wait a minute. That guy did a $5 million deal and we're only doing 10. Be patient. 10 million, 1.5 million purchase price, 10 unit property. Remember how in my book, How to Own 1,000 Apartments, 5 years. You start off with 20 in the first year. 5 cap rate. These are all numbers. You can just work it out. Now, here's what we do in our business. The same thing that Warren Buffett does. We decide that we're going to find value. And we found a 10-unit property where the landlord has not increased the rents in the last 5 years. And they're $250 per unit below the market. Would Warren Buffett buy a company with that type of spread in value? In a heartbeat, he would do it. We're going to do the same. Now, let's assume, because it's a smaller property, it's a 25% loan to value. 75% LTV. That's a typo. I got to fix that. 75% LTV. So it's $300,000 down payment. So I have to come to the table with $150,000. My partner has to come to the table with $150,000. We buy the property for $300,000. I mean, you can get that on credit cards. You can do whatever, but because of the value that you're unleashing, you can afford to do it because there's so much room in this deal. By increasing the rents by $250 and just assuming that that 90% of that money, new money, drops down to the bottom line. In other words, if it's a 50% expense ratio on this new money, I'm only assuming a 10% expense ratio because we're not really spending anything more every month. We're just increasing the rents. So I'm assuming out of that $250 times 10 times 12 times 0.1, our new value at a 5 cap increases the property's value by $540,000. And if we could do a 75% a cash out refi, we now put $510,000 in our pocket. Does anyone want to talk about 9% preferred returns? Or do you really want to just talk about the power of the cap rate and how increasing the net operating income by $1 has just increased our net worth immensely? Who's going to get to $1 million faster? The passive investor who's getting his money from his friends and family. Joel Friedland, thank you very much. Who's going to get to $1 million faster? But I just did 10 units. Can you do that? Everybody here can do that. Everybody can do that. So what if your funds remained in the real estate? What if you had to reinvest in another deal every 5 to 7 years? What if instead of paying the preferred return, you took advantage of the power of the cap rate? What tax advantages exist when you pay taxes on your 9% preferred return, as well as your taxes on your final distribution? How much faster would your portfolio grow if you refinance funds out of your deal and reinvested them, as well as taking advantage of a 1031 exchange? In other words, folks, the way you make millions in real estate is by taking advantage of what the government has allowed us to do. We just increased our net worth by $540,000. How do we unlock that money out of the property? We refinance it or we sell it. If we sell it, do we have to pay taxes? No, not if we do a 1031 exchange. The government allows us to take this money and go out and do it again. And that's how people make millions. If you're getting a 9% preferred return and the guy's going to flip the property in 5 years, where are you going to be 5 years from now? You're going to be looking for another GP and hoping that the money that you return to grandma is what you said it was going to be 5 years ago, in the hopes that some other guy did it. Folks, this is the method for getting you to where you want to be. Which model is correct? They both are. And just remember, Warren Buffett was a passive investor before he became the owner. The night he started buying shares in the company in 1962 as a passive investor and has been at the helm ever since 1965. 6 decades later, it's now the 7th most valuable enterprise on the planet by market cap. Okay? keep that in mind when you think about which model you see yourself doing over the next couple of years. And really, folks, that's all it takes is a couple of years. Someone who invested $1,000 in Berkshire Hathaway in '64, it's now worth over $10.5 million. Folks, this is not a buy and hold strategy. It's a buy and reinvest and reinvest and reinvest every dollar. If you find passive investors who like the Warren Buffett model, good for you. Those are the people who are going to just stay with you and let you keep reinvesting. And on top of that, do the same thing that Warren Buffett has done. You build a property management company as you grow that pays you and that partner 5 cents on every rental dollar that comes back into your bank account, and you never touch the capital. That's how millionaires get made in this business. So, did I hit it? Yeah, that's it. That was it. That's all I'm here to tell you today. These, the people that I know who are multimillionaires in multifamily investing didn't do it on the passive investing model. Passive investing model has made the sponsors millions. It hasn't made the LPs and the people who are just, trying to touch the hem of these sponsors. Hasn't made them the money that they think they're going to be getting. It's a good place to park your money, but the problem with that whole model is at some point you're going to have to unload it. And I keep referencing the egg farmer, John Dobens, the egg farmer. His family has held on to all their assets. They buy more. They use that property to just keep buying more. That's how you make millions in this business, folks. And folks, that's all I got for you today. Any questions? Anything? Anybody want to speak out? Say something? Something? No? That's all right. I hope you enjoy this presentation. I hope it gets your mind thinking differently. That's the key to the riches. And folks, everyone here on this call can buy 10, 20 units next year to get started in this business. That's the model you need to be, reinvest it. Got it. Right. Thanks, G. G, what? Did I have to explain that to you? Did you really need to have that explained? So good. I appreciate that, Good Samaritan. I think you guys get the hint. That's the way to do it. And that's and I'll tell you something. I'm meeting with my my vice president of sales tomorrow. We we go through sales interviews with people to join our program, the MultifamilyOS program, and we go back and we ask them, what do you think? Why didn't you sign up with us? What are your fears? What can we do differently? How can we explain it? How can we explain it differently? What can we do to get you in? Got some great feedback from people. And I think part of the problem is that one of the biggest objections that people have is that they are afraid of raising the money, or they won't be able to find the money. Yeah, that's when you're being taught this go big or go home model. I want to teach people that they can get to be the biggest one in their market by just starting small. That's all it takes. Can you say something about your program? Okay, sure, Carlos. First up, hey guys, one of the newest things that's coming about is hotel to apartment conversions. This is the new buzz, and I'm invested. I'm an owner. Full disclosure, I'm an owner in 3 hotels. And let me tell you, the numbers are phenomenal. And let me tell you, it's a lot different than multifamily acquisition. So it is a different road, and asking whole different questions, asking whole different set of questions for the due diligence. But my partners in that business is also a client of mine. He's the smartest man in any room. So when he walks in the room, I am no longer the smartest man in the room. I'm still the best looking and tall. But yeah, no, he's a pretty tall guy too. But it is, we are teaching. The Multifamily Investing Academy is now going to teach a seminar on hotel to apartment conversions. It's going to be a 2-day seminar. It's going to be held in Chicago and in Fort Lauderdale. I see Deb's on the call right now. Deb is putting together the final touches on the sales page, and it's going to be released on Saturday. And so I highly recommend that if you're looking for a way to get into multifamily, this is a great way to do it, because what we're also going to be doing is looking, finding people who find deals and us getting involved. That's how these, one of the deals I'm invested in came about from one of my students in my program, found a great hotel conversion opportunity, called my other client, who you will all be meeting at these events and teaching us, called him and said, "Hey, do you want to do this deal together?" And he said, "Yes, this is a great deal." And they came to me and I said, "Yes, I will put debt and equity into the deal myself." So I'm not only an investor in the deal, I'm also a lender on the deal as well. The numbers are unbelievable. Let me ask you this, and I think Deb is actually going to be sending out an email. I don't know if it's gone out yet, but the subject line is 79 unit, 1-bedroom apartment complex, $39,000 a door, fully refurbished, 100% occupancy. That's what the subject line says. Folks, I just described exactly this hotel that we got into. We didn't have to do any rehab. We didn't have to do any refurbishment. It was already done. We got that property. We're converting it to a multifamily. We purchased it for $39,000 a door. You go out, you look anywhere in the country for solid C plus, B minus, probably a little bit more B minus because they're nicely refurbished. And it's not a bad area. It's a tertiary market. You find any multifamily deal, and the value of a 1-bedroom is easily 6 figures, maybe 150 in some of those markets. We purchased ours for $39,000. We're going to get the same type of NOI that you would if it's a multifamily property. Those are the types of deals that you're seeing in the hotel conversion. It's called building recycling. We're recycling the building. It's a lot easier. It's tough to find multifamily. I mean, they're just not building them fast enough. And now hotel conversions are the thing. We're teaching you exactly how to do it. Schools to apartment, absolutely. I've seen some beautiful ones. I had a guy, one of my students, 32 unit school to apartment. But think about it, the schools, that's because the municipality was through with it. Okay, look at hotels. Hotels are not coming back after COVID. The biggest property class that is being taken back by the banks right now is hospitality, and this is our opportunity to jump on it. It's a fantastic deal. So that's going to be. You'll find out more about it, and then also I see Carlos. Carlos, my program is the best thing out there. There's nothing like it. I mean, I teach you how to build a business. I provide you the tools for the sales and marketing component of your business, how to find the deals, the things that my system does for you. No other person even comes close. But it's too much to talk about here. I got some great staff that can explain it to you. Make sure you go check it out. I think Deb, she's logged in there as me. Multifamily Investing Academy. She can definitely reach out to you, Carlos, and walk you through how the process works. But my whole process is how to build a business that gets you to 1,000 apartments, and you don't have to, think you got to go out there and raise millions to do it. I like to teach you how to build the system the right way. Go big and go home. That's what some people say. Fine. You want to do that? Go right ahead. Or you can be the tortoise, and just, you can be the tortoise and just give me 5 years and I'll have you owning 1,000 apartments. I've already done it for several of my students. So it's my model works. Okay. Anything else here? Good to be reminded. Charles, can you say something about your program? Got that, Carlos? I learned something every time I listen to you. Thanks, Yana. All right, good. Thanks, Good Samaritan. I appreciate that. I'm glad you guys liked it. Watch for the new hotel conversion. This will be the first time I'm conducting any live seminars since COVID started. I'm excited to get back out there. It's going to be in Fort Lauderdale, and it's going to be in Chicago, and it's closed. It's only 150 seats. That's all I teach to. Especially up in Chicago, it's an amphitheater room. It's not like they can bring in chaise lounges and set you up in the front of the building. So it's very limited to the number of seats that we have. So that's that. And I would love to see you all there. I think you'll be blown away. And before I hang up, let me give you an example of things you don't know about hotel to apartment conversions. Received an email from my partner in this the other day, and he said, good news. We just got word from our electrical engineer that the property that we own, the electrical service is big enough to support stoves, oven and stoves in each unit. Okay. When we bought the property, we knew we'd be putting in kitchenettes, and worst case scenario, we would give everybody a little a cooktop type of surface in order to cook on. Now, because we have the right electrical service, we can now put in ovens and stoves, which means we can finance the deal with government-sponsored paper. Fannie and Freddie will lend to us, which means we can get non-recourse paper, which means we've just lowered our cap rate in this property. Other investors, when we go to sell or refinance, we have so many more options now just because of that one thing. You've never had to think about that before when it comes to multifamily acquisition, but these are the types of things you need to think about when you're doing a hotel conversion. And that's what my conference is going to be teaching all 2 days long. Chicago is a Friday and Saturday, and Fort Lauderdale is a Saturday and Sunday. So I hope that was helpful. Thanks, everybody. And I'm going to end the broadcast. This is where I do the old Carol Burnett. See y'all. Good to see you.